From the land-grant University in Urbana-Champaign, Illinois, this is the closing market report for the 5th day of March, 2026. I'm Extension's Todd Gleason. Coming up, we'll talk about the commodity markets with Matt Bennett. He's at agmarket.net. I'll update you on some of the latest from Washington, D.C. as it's related to agricultural policy in the Ag News segment. And then we'll have a discussion about crop insurance decisions. Even if you have already made yours, you may want to change them after listening to what Gary has to say and or going to the YouTube website or our own WILLAg.org to watch this morning's webinar. It's an hour long. I'll talk to Gary a bit later in the program today to give you a short version of that webinar about crop insurance decisions on this Thursday edition of the Closing Market Report from Illinois Public Media. It is public radio for the farming world online on demand at WILLAG.org.
Todd Gleason services are made available to WILL by University of Illinois Extension.
Nearby May corn for the day at 4.53 1/2, 9 3/4 cent higher. July up 9 1/4 at 4.62 3/4. December 4.78, 7 3/4 cent higher. May beans $11.79 1/4, 9 3/4 higher. July up 9 1/2 at $11.92 1/2, and November futures $11.36 1/2, 6 cents higher. Wheat futures in the soft red July at 5.93, up 15 1/4. The hard red July 6.05 1/2, 19 3/4 higher. Matt Bennett from agmarket.net now joins us. He's traveling in Iowa today. Hello, Matt. Thanks much for being with us. Why are you there?
Yeah, so, I've got market to market this week, and they wanted to record it on Thursday instead of Friday. So had a couple people wanting me to do a meeting in this part of the world. So I did one this morning, and I'm doing one this evening, and then I get to go home. So it's going to be a little bit of a busy day.
It will be a busy day. Those who want to see what you have to say on Market to Market can, of course, pick it up on Channel 12 if you're in the viewing area around Urbana-Champaign. That's about an 80-mile radius, so most people can check it out. You can also see it online, too. That's Market to Market, 11:30 Sunday mornings on WILL Channel 12. Now, what do you think you'll talk about this afternoon?
Well, maybe today's market a little bit. I mean, this is the best market we've seen in a while. Clearly there's a lot of angst about what's going on in the Middle East. Availability of fertilizer. I know a lot of the guys we've talked to in different parts of the country have, basically been told that they can't get a price right now on different types of fertilizer. And so, I think the market's a little bit hyped up about that. No questions asked. Obviously with corn, exports were just incredible again this morning, 2 million tons again. And so, essentially what we're seeing is that, you look at inspections, which we talked about this at the all-day ag outlook, but, inspections running almost, after today, probably over 45%, ahead of what we were, a year ago, whereas the USDA is only forecasting a 15% increase. And so, at 3.3 billion bushels, actually, pace analysis would tell you they're too low right now. So it's really been a dynamic situation as far as our exports are concerned. World corn prices for us very competitive out of the U.S. still. Argentina's a little cheaper, but quite frankly, we've got more to ship, and a lot of people are wanting to buy off of us right now.
Corn, you think, is trying to keep producers of the mind that they will plant corn acres this spring, despite the fact that the price of nitrogen may go up?
Yeah, I mean, I think a lot of nitrogen. The nitrogen run last fall was big. I mean, there's no question.
That was my secondary question on that.
Yeah, I mean, that was a big run. Now, where it wasn't a big run, Todd, was your dry fertilizer run. A lot of guys are like, shoot, I'm not paying $900 for DAP. And so some guys were kind of betting on the come there, and prices had backed off some. I've got to think some guys still bought, but I do think that the fertilizer application for this year, particularly on dry, is going to be well short of what we typically see. Is that going to impact this national yield a lot? You can go a year without it, but it's certainly a sign of just how stressed things are, out in the countryside. So, but yeah, anhydrous run last fall was really good. Clearly there could be some issues getting a hold of it here this spring. But at the same time, that's probably getting blown a little bit out of proportion right now, which has given us opportunity, that we haven't seen for some time.
I kind of wish at this point USDA still had the funding Iowa used to give us numbers as to how far along fertilizer application was in the fall and the spring. Those went by the wayside. That's too bad. Otherwise, we'd have a really good indication for that state. It was the only state that actually showed up in. So now, soybeans followed along, but of course not proportionally. Was that just in sympathy?
Yeah, I think the bean market's had one heck of a run here lately. Since you said that they might buy another 8 million tons off of us when China news there. When you couple that, of course, with the RVO, the 45Z, a lot of the I guess excitement in the bean market, I think, has been priced in at least for the time being. You can't forget. Most of your estimates are 180 or above as far as the Brazil crop goes. So, even if China would step in and buy more U.S. beans, which, a lot of folks still think that's a possibility. It sounds like the deal or the meeting between Trump and Xi is still on. If that's the case, and they do go ahead and buy a few more beans, I think what's probably going to happen, Todd, is that we're going to end up importing beans or bean meal into the Southeast. So it's not like we're going to run out of beans. It's just you could have a razor thin balance sheet for the U.S. Potentially. I'm not counting on that right now, but it could happen that way. But if it does, world balance sheet's going to be more than adequate.
Do you think that the Venezuela and Iran removal of the heads of those nations and the shutdown of what have been primary sources for oil to China will be a chip that the president can play directly in China in that meeting, so that there might be more ag products that get purchased, or is it the other way around?
I mean, I'm assuming that's what he's going to go for. There's no question in my mind that that's the angle that he's going to use. I mean, I still think that as long as he feels confident that the way they're going to go more strategically about these tariffs, that they're still going to try to say, hey, we're going to keep these tariffs at this certain level here. It's up to 15% now, and we're not going to go whole hog and get crazy on him, which I don't know that he's got the ability to do that anyway. But lower tariffs for China certainly means that they're going to make a heck of a lot more money off the products that they're selling to us than what they're going to have to spend, for beans that are running $1 higher than Brazil. So, in my opinion, he's still going to try to take the same type of angle that he is. Does it mean we're going to sell more products to them? I think it's anybody's guess, but we got to certainly hope so.
Any thoughts on next week's WASDE report before I let you go?
I don't think there's going to be a whole lot in the way of changes, Todd. I mean, if they maybe drop Argentina a little bit on production, they've certainly struggled to get the rainfall. But as far as the U.S. balance sheet on corn and beans, I kind of feel like they're going to want to see what usage looks like in the quarterly stocks at the end of the month. And of course, see what acreage looks like then. That'll be the much bigger report to look at.
We'll look forward to watching you Sunday morning on Channel 12's Market to Market, and good luck tonight with them.
Absolutely. Appreciate it.
That, of course, is Matt Bennett. He is with agmarket.net. In today's agricultural news, the top House Ag Democrat charged in a super-partisan farm bill markup that the Farm Food Coalition is dead, and this may be the last traditional farm bill. Angie Craig complained Republicans wrote a partisan farm bill that cuts SNAP amid high grocery prices and shifts program costs to the states. Craig hoped the Senate would do better, but as far as the farm bill's future right now...
For some of us, this is your first farm bill markup. For all of us, it could likely be our last, because by decimating the nutrition title of the farm bill, by splitting the food and farm programs apart, as Republicans have done in this process, you have destroyed the Farm Bill Coalition.
But Ag Chair G.T. Thompson was having none of it.
I've heard it over and over again like a broken record that we broke the long-term Ag and Food Coalition. Well, if the Farm Bill is $1.3 trillion and $1.1 trillion is the food side of it, that doesn't seem like a very strong coalition. That broke a long time ago, and we disadvantaged the people for decades who actually grow the food that is consumed by everybody.
Democrats offered amendments to roll back SNAP savings like cost shifts and work requirements in last year's tax and spending bill. Majority Republicans voted them down. Illinois Democrat Eric Sorensen was furious that veterans were not exempted from work requirements to get meager daily SNAP benefits.
I cannot believe that we are here today, and people on the other side of the aisle are saying, you know what? Sorry, you may have gone off to war, but go get a job and then come back to us for your $6.
Chair Thompson called it disgusting if veterans weren't ever given an upward pathway to a job. Other less controversial amendments were either passed or withdrawn. Mandating CRP base acre updates did not make it. Increasing some loan limits did. Writers challenging the president's tariffs went nowhere, while the House Farm Bill markup continued late into its second day. Elsewhere in Washington, D.C., there continues to be a great deal of discussion of fertilizer prices as it's related to the attack on Iran. The now closed Strait of Hormuz moves about 20 million barrels of crude oil and petroleum products daily, totaling about 20% of global demand. DTN reports that fertilizer exports also move through the strait, including about a quarter of the globally traded nitrogen market. Now, Politico said the White House will offer naval escorts and political risk insurance for oil and gas tankers traveling through the Strait of Hormuz in a bid to slow down a surge in energy prices after Iran warned it will attack ships at a choke point in the strait. The announcement brought some immediate relief to the overheated crude oil market. Politico reported in a Truth Social post, President Trump said he's ordered the U.S. Department of Finance Corporation to provide risk insurance and guarantees for the U.S. financial security of all maritime trade, especially energy. If necessary, the U.S. Navy will begin escorting tankers through the Strait of Hormuz, Trump added. And finally today, the tech industry's relentless push for data centers in rural areas is colliding head-on with farmers who see the projects as a threat to their way of life. Politico said the issue is drawing vocal criticism from conservative candidates for political office and fueling unrest in Republican primaries. Data center supporters are looking at vast parts of the nation's farmland as excellent sites for the sprawling, server-packed facilities they need to support the White House goal of making the U.S. the dominant force in developing artificial intelligence. And that's a quick look at today's agricultural news. Gary Schnitkey, agricultural economist here on the Urbana-Champaign campus of the U of I, now joins us to take a look at crop insurance decisions that producers across the Midwest will need to make for both corn and soybeans by the 15th day of March. There's an insurance evaluator on the FarmDoc site. We'll talk about that in just a bit. But Gary, this year is new and a bit different for crop insurance because there are ECO and SEO products which have been around for a long time. But the One Big Beautiful Bill Act, along with some movement by USDA, has subsidized those two particular products at the 80% level. And that really changes the way you have thought about what producers should do.
No, the 80% subsidy, which is an increase from 65% last year, is a game changer in my opinion for ECO and SCO. It makes those products cause them to have positive net benefits for the farmer, which means that over time, farmers should expect to receive more back in payments than they put into farmer-paid premium, and that results from the 80% subsidy. So RMA is supposed to be setting the premium so that a little under $1 is received for each dollar of premium. Farmers are only paying 20% of it, so for every 20 cents they put in, they should be getting close to 90 cents back. There's a loss reserve built in there. Well, it doesn't quite work out that good. It's 20 cents in, 45 cents back, but that's still a positive return over time, and farmers will benefit from that positive return.
That's for the state of Illinois. Other outlying areas have different ranges, roughly speaking?
Yes, that's for Illinois, roughly the Midwest overall. Those ranges outside of Illinois tend to have higher or better rated products so that they get a higher payout relative to the payments they pay in relative to the Midwest, in particular the states from Ohio to Iowa.
I'm sure that there will be much discussion about the actuarial tables in the future and how they can or maybe should be adjusted. But today we're talking about crop insurance for this year. This is a game changer, ECO, SEO. What's kind of the bottom line for producers, I suppose, not only here, but across much of the Midwest, as it's related to how they should deal with this? And then we'll take up that insurance evaluator and how they can see it.
Yeah, so the thing that I would say you want to do is take ECO at the 95% level. There's two levels, 95% and 90%. I would suggest taking it at the 95% level, and that will provide county-level protection from 95% down to 86%. So that's the number one thing. Take that policy. And then, number two, you might want to lower your RP policy coverage level. If you've been taking 85%, you might lower it to 80 or 75%. And if you lower it, you're going to have the same premium as if you just took the RP 85% policy, but with better risk protection. And then you might think about adding SCO from 86% to whatever your RP policy is. But the big thing is take a look at that ECO 95%, and then if you're concerned with premium and payment levels, just lower the RP to 80 or 75%, add some SCO, and go along your way. And you'll have the same farmer-paid premium as roughly last year, and you'll have better risk protection and a higher net benefit.
Those who want to learn more can always visit the FarmDoc website or FarmDoc Daily and look under Events and Archives. There is a brand new webinar that's been posted there, an hour long, that'll take you through all of this. Or you can simply go to youtube.com/@FarmDoc. That's slash the @FarmDoc. And you should see that webinar. It's, of course, from Thursday, March what is today? The 5th or the 6th or thereabouts? 5th. And you can check that out. Also, we'll put it on the homepage at willag.org, WILLAG.org, and it'll be the only YouTube video there, so you can check it out. I do want to talk about one of the last segments in that, because you were talking about the payouts. You have something you call regret, the regret, and how this differs over time. So if I just took a RP 85% product, as opposed to, let's say, 75% plus SEO and ECO, what's the regret? I mean, the regret would be, will that RP product alone pay out better?
Yeah. So let's just make that comparison explicit. RP 85 versus RP 75 plus SCO plus ECO 95%. That combination will have a lower premium in most cases than RP 85. It will have a higher net benefit. For corn, it's often $35 higher. For soybeans, it's $15 higher. But there's a 5% chance that bundle RP 75, SCO, and ECO will pay less than the RP 85 policy.
In any given year.
And that's just 1 in 20 years it will pay less. And in that situation generally is the RP are the underlying triggers somewhere between 85 and 75%. You don't get down to 75%, and the ECO and SCO aren't triggering.
Okay, now let's get down to some nitty-gritty. If people want to compare these products on their own, there is a really good crop insurance evaluator tool. It's a calculator that you can use from the FarmDoc site at FarmDoc Daily or FarmDoc, either one, .illinois.edu. Under the tools, it's the crop insurance evaluator. What does it do and how does it work?
So what it will do is you'll select a state, county, crop, and you can also select a basic and optional unit, and it will give SCO estimates of payments for all different combinations of products. But what we would suggest you do is you enter what you did last year, and that might be RP 85%. And it'll say this is what the premium will be this year. This is what we would expect the average indemnity to payment to be over time. It'll give you the probability of having a payment, net benefit, and then a worst loss scenario. Then you can go into compare mode and you can add different things and compare how that compares to your basic product. And again, if you start with something like RP 85 and RP 80%, then look at adding ECO and SCO and looking at what that does to farmer paid premiums. Depending on what you do, you can lower it and increase your expected benefit and also increase your expected worst case scenarios.
Yeah, so it is very neat because you put what you did last year in, shows up in one panel. There are 2 more panels by default. You can add extras where you can change and you can see in real time what the changes would be to add SEO, take ECO off, those kinds of things. And you can compare at least 2 products, different products, or possibly several others if you keep adding to them. It is in the compare mode. You do need to remember to hit that up at the top, but it's a very nifty kind of evaluator. Folks can see that again by going to farmdoc or farmdocdaily.illinois.edu, looking under the tools section for the crop insurance evaluator. It differs from the crop insurance premium development tool, so make sure it's the crop insurance evaluator. As we wrap up again, let's go back through recommendations at this point across the state for corn and or soybeans, and do they differ very much?
They don't differ very much. Look at ECO 95%. Take that one. You may think about lowering your RP coverage level. If you lower your RP coverage level, you'll get a farmer paid premium roughly the same as last year. It's important as we're looking at cost, obviously. And then think about adding SCO.
Thank you very much.
You're welcome, Todd.
Gary Schnitkey is an agricultural economist on the Urbana-Champaign campus of the University of Illinois. If you'd like to learn more about the crop insurance evaluation tool, or just simply the crop insurance decisions that Gary Schnitkey, along with Nick Paulson, our thinking producers across Illinois, the Midwest for that matter, might make on corn or soybeans prior to the March 15 deadline. You can do that on the FarmDoc Daily webpage right now. Look for it under Events and Archives. You'll find it there, or you can just go to youtube.com/@FarmDoc and look for that webinar. Also posted to the WILLAG.org website. That's WILLAG.org later today. You've been listening to the Closing Market Report on this Thursday afternoon. I'm University of Illinois Extension's Todd Gleason.